Jackson County is in a strong financial position despite dwindling federal payments meant to offset losses in timber revenues for counties. That, according to James Lanzarota, partner with the auditing firm Moss Adams LLP, in a recent presentation to county officials.
The next item on our agenda today is a special presentation, the annual financial statement audit from Moss Adams.
So I'm Jim Lanzarota, partner with Moss Adams. You have engaged us to perform your external financial statement audit, which has been done and delivered back in December, but we're here now just to share with you the results, kind of complete a process. So this financial statement document is put together by your staff. A majority of Oregon municipal corporations are unable to produce this document in-house. So they either have to hire their auditor to do it or hire someone else to help them. Your staff does it. So a big part of our audit is really testing this to make sure that it is put together correctly and meets all the requirements.
So our opinion on the financial statements. You received an unmodified clean opinion. That means at the end of the day, we audited your financial statements and we noted that they were in compliance with the accounting standards that you follow, with reasonable assurance that there's no material errors. So that's great to be able to put together a document of this size and to not have material errors is a great accomplishment. And so congratulations on that.
I guess the point I just would like to make is it's very difficult, and in my experience, I don't even know if I can count the number of times on my hand that you can get through an audit of a governmental entity this size, have a clean opinion, no internal control weaknesses that need to be communicated, no non-compliance with state laws, and no non-compliance with the federal grant programs and the compliance there. So that's like a trifecta right there you guys hit. I tell people I think perfection is nice to strive for, but it's probably an unattainable goal. And this is probably about as close as we've seen in a long time. So really, congratulations to all of you for your efforts that got to that. The other thing that we don't often do when we do audits is talk about the finances. I mean, the audit really is not directed towards whether you're financially sound or not, or whether you're improving or declining. It's really more about whether this document is put together and is accurate. And so we just had a few slides that might give you some perspective. It's very high level, but so a couple slides. This is just an idea of where your major sources of revenues come from. So you get a lot of grants and contributions from other agencies that help you provide your services. Your charges for services, kind of flat. You're up a little bit, 31 million. Not a lot of growth there over the last few years. Property taxes is another area. It was kind of declining until this last year. So you're right in about 39 million there. And so all told, you were 170 million 4 years ago, now 153. Probably a big chunk of that is the loss of the O&C or the timber revenues, and perhaps some other grant programs have been a little hard to come by too. You've probably had to work pretty hard to keep the same level of resources there. And Danny, if you're welcome to chime in if there's anything you want to add or talk about here.
Well, I just want to point out that you made the point, but I want to emphasize it a little bit, that the majority of services that we deliver to our citizens in our county do not come from our property tax base. The property tax base couldn't support anywhere near. In fact, it's not even based on the revenue report you just gave, a third. People often have also said over the years that they don't see our county government shrinking. They see us spending more and more dollars. And as you can just see, our revenues have shrunk significantly. $20+ million a year that we've had to cut. And so we have made those cuts. It's reflected in your audit and in your report. And I just wanted the public to be aware of that.
This is the expenditure side. And so this shows you just, again, some very big major categories. The general government, your administration of the county, you're actually spending less now than you were 4 years ago. Community justice and safety, that's been flat. Look at that. You've had no growth in expenditures there. Health and Human Services, that's an area that's taken some hits, a little bit of a bump this last year. Transportation, you see, has got a nice bump 3 years ago, but you've had to cut in that area. So all told, you were spending 160 million 4 years ago. You're down to 146 million this last year. This is a slide that I like to show. It's probably this tells you from a financial standpoint. So Danny talked about the constraints you've had, loss of revenue. You've had to take some very proactive steps. And one of the things that I really appreciate about Jackson County is that you've done, if you evaluate it from a financial standpoint, you've done very well in meeting those challenges. So this first bar, that kind of bluish bar there to the left, if you were to take all the county's assets and sell them off at book value and liquidate all the debts, that's what you would have left over. And what you want is a trend line that's increasing. When bond rating agencies and other folks look at government entities, they want to see increasing capacity to deliver services. The only way you can do that is if you're growing your county. You've held the line. You were 470 million 4 years ago. You're 470 million now. And I would say that's an amazing track record given the loss of revenues that you've been able to maintain that. The other bars are elements of that equity. So the biggest one is what you have invested in your infrastructure. That's buildings, roads, bridges, equipment, and what's interesting there is you've been able to make investments. So even though you haven't increased the overall equity of the county, you have been making investments in your infrastructure, and that's very critical to deliver services. Some of the governments that probably have better credit rating than you do, that's been a declining trend where they haven't been able to make the investments in their infrastructure, so they're going to have a big check they're going to have to write at some point down the road. You've been writing those checks and kind of keeping things maintained, so a very good trend line there. And then finally, the last bar is the unrestricted resources. So that's spendable, available resources that have no external restriction on them that are available to you, and you can see that has been as high as 100 million a few years ago. It's down to 83 million. So it's been a little bit of a decline, but still what this shows me is overall stability and the investment in infrastructure that enables you to maintain service or to provide services.
And I just want to be clear that is not just operating revenue, that's operating revenue and fund balance. In other words, we don't have $83 million to spend every year.
Correct.
We have $83 million in the savings account that once we spend, a good portion would spend down our fund balance.
And then a lot of people like to look at the general fund in isolation. This is generally the pocket of resources that you have the most control over that don't have as many strings attached usually. So this shows you the revenue and expenses and the fund balance at the end of each of the last few years. So you can see that's been declining. You were at 73 million in 2010. You're down to 47 million. And go ahead and do the next. And
can I stop you right there? Yes. I think one thing that's important for people to understand, 4 years ago when we were at $73 million, we had the highest fund balance in the general fund of any county in the state. And that includes Multnomah County and counties that are in better tax situations in terms of the revenues they generate from property tax base. And at the current rate, we're the second highest fund balance of any county in the state. So while we've spent it down, making those investments in capital improvements or capital infrastructure that you talked about, we also have maintained a very secure position, especially as compared to every other county in the state.
Yeah, that's very true. And this next slide kind of helps illustrate that as well, because one of the things that credit rating agencies look at, other folks that try to get a sense of how stable you are, they want to see the percentage relationship of your fund balance to your expenditures. And you were over 100%, 5 years ago. You're about 75%. The GFOA best practice is probably around 15%. So this, to me, with the strong management, you should be getting excellent credit ratings if and when you need to go to market and issue bonds. And that's very difficult to do for these smaller counties, especially the ones that have been dependent on the ONC and these timber revenues that you have been fortunate to receive, at least until now. For Oregon PERS, you're going to be allocated your proportionate share of their position. And And what I'm here to tell you, I'm blown away by it, but all of the changes that have been made at the state level to benefits and the investment returns that they've enjoyed the last couple years, you're actually going to have a net pension asset to book, if you can believe that. And the preliminary numbers are out. They have not been audited. We're going to meet with Shannon after this meeting and talk about it. But in your first year of implementing this new standard, you're actually going to have a negative net pension expense to run through the income statement too.